Well, welcome back to the rest of today's session. Our focus for the week has been real estate and tokenization, fractional ownership, and now we're on the session, and I'd like on how to promote real estate and attract the right investors. I'm very excited to have two terrific marketing and investor acquisition firms with us. I'd like to welcome aboard Jillian Bannister from EXT Marketing and Andrew Korn from E5 AIM Marketing. Welcome, guys.
Thank you.
This is the most fun topic for me when we talk about marketing because it's part science, part mad science, and a lot of analytics and a lot of trial and error. And you guys have been extremely well versed and experienced over the years with all the changes going on. So first and foremost, I want to welcome you, and I'm going to invite the audience to ask all kinds of questions. This is probably the biggest challenge that anybody taking advantage, or when I say taking advantage, utilizing the opportunity of Reg CF, Reg A, and Reg D. The exemptions themselves afforded the ability for to cast a wide net to the marketplace when it comes to presenting offers. And now specifically, we're going to talk about real estate, but presenting your offers to the public. And there's a lot of education that needs to be done. So kind of as a jumping off point, maybe you guys can give me, and I'll start with Jillian first. When we look at the real estate space and the marketing outreach, where do we begin? I'm a company, I want to raise capital, I've made a decision on a regulation, or perhaps I haven't, and I've already spoken to you. Take me through the little bit of a journey first, and then we'll dive into the fine tuning of this.
Yeah, sure. Thanks, Peter. So, yeah, I mean, it is a journey. I think that's well said. We always start with, the core. First of all, EXT is a full service marketing agency. We specialize in, all aspects of the financial services stack, I'll say, including capital raising for issuers. So what we always start with is looking at key messaging, looking at clear objectives, looking at your brand, and making sure you have those foundational things. We work with all platforms to, make sure that we're on the same page, and whatever structure you're deciding to go with, that really does help us inform the kind of key messaging and who your target audience is. So that you'll probably hear Andrew and I come back to many times in this segment, where the message really matters and understanding your audience is critical. And the other piece is your audience is in a lot of different places. So our job is really to orchestrate all the very avenues and strategies to help optimize getting your message out there. And that can change. It can change with the markets. It can change, obviously, real estate, the sector, the geography, where your projects are. So we really want to do a deep dive in understanding, about your business. So, that is going to be a huge part of the first part of the journey, is really unpacking all those things, which are, strategic discussions, and getting you onboarded before we jump into building and executing on a plan. Once we have the strategy, we move to the next gate, which is creating the assets and then activating the plan.
So I'm hearing a couple of things here. I'm hearing understanding the business. I mean, we're talking about real estate here, so I guess it's not quite as simple as say, hey, I'm doing residential properties, or I'm doing a REIT, or I'm doing something else, or I'm targeting accredited investor or non-accredited investors. There's a lot of pieces here, and then you have to figure out, okay, what are my marketing channels? Social media, email. How do I go about it? So I'm going to jump over to you, Andrew. Where do you begin in this journey? Is it understanding? I'm a guy that I want to use a Reg CF or a Reg A or a Reg D for real estate, and I need a marketing guy. I'm jumping off the bridge here, so catch me.
I think that's great. And, We have a very different approach than most agencies. Let's start with, we are a systematic data-driven investor acquisition firm. So 98% of our work is aimed at acquiring investors. We do work across asset management as well as doing cap raises, but it is our only work. And we aim institutionally, we aim at advisors, and then we aim, of course, direct to retail. The first thing we want to know is how much money you currently raising that you want to raise. How much money do you currently manage? Because if you've done 3 one-off deals with buildings and now you want to create your first fund, in our opinion, they're not a great candidate for Reg A+. So the track record needs to be there. We need to know that you've delivered things specifically to investors. You've delivered yield, preferably monthly, but quarterly is fine. That there's been growth in the investments as well. So a lot of what you're marketing with real estate, keep in mind, no one's buying it or investing to live there or to store their materials, but they're doing it because they want steady income, they want inflation fighting, and they want some growth on the back end. So we want to make sure that the issuer is capable of all of those things. Second is, we don't touch Reg CF. We don't do any small raises. And the reason is, and I'm confident that Jillian's firm does the same thing, we put our heart and soul into this work. We work on it morning, noon, and night. Even when we're not physically at work, it's rare that something doesn't come up where it'll be, could I use that for one of my clients? So then with that, it'll be, who have you raised money from before? And why do you want to go Reg A+? Because now we're talking all the way down to non-accredited investors. So we do a bunch of audience identification, and then we see, can we acquire that audience? Meaning, can we get really good data on that audience? So we have a lot of proprietary data sets. We've got nearly 1 million doctors and dentists in our own database. That is an E5A database that we use for our clients. We've got people with a pilot's license, which we find to be very self-directed as well. And then others, it'll be, this should really be a Reg D. It should be aimed at advisors. Let's go independent. What custodial platforms are you on? Or do you need help getting on? So that's a completely different type of raise. Or we've done this too, where the raise is over $1 billion and it's purely institutional. And then it's, oh, we're going after public funds. We're not going after sovereigns at that point because it's too small. But are we going after endowments and foundations, family offices? So each of these are different types of raises, and we need to make sure that there is an audience issuer fit before we'll accept the assignment. In way of background, I am a former multi-factor model portfolio manager. I managed over $1 billion actively, and then had well north of $2 billion in ETF assets, where we designed the indexes behind the ETFs. So it's a slightly different perspective. We want to make sure that we are going to be successful when we accept the client and get into the raise. Also, our firm only works in 3 areas. One of them is yield, one of them is innovation, and one of them is ESG. So frequently real estate will cross a bunch of those. But, is it multifamily? Is it self-storage? Is it industrial? Is it mixed use? Is it hospitality? I mean, every one of these, medical, they all have slightly different pluses and minuses in who we would go after. And then structure, you mentioned REIT. So I could go on just about what we do before we even are engaged. But I don't want to,
and this is excellent. What I'm hearing from both of you is, and I like how you put, the audience issue and the fit. So on one hand, you're articulating the fact that you're selective on the clients that you bring on with your firm. I'm going to make some assumptions too that's from a business decision. you can be as effective, but there's also likely bandwidth issues that every firm has. We experience that with whether it's the legal community, whether it's a broker dealer community. They say, hey, we're optimized right now, we can do this. And then other ones are strategic. I want to be the best in a category that I can address. So audience issue fit, knowing your client first. What I'm hearing is, and what I would suggest to our audience then is, when you're having conversations and to engage with investor acquisition marketing, and I use the term as it bounces around a little bit, but ultimately you are marketing firms. I mean, you're marketing on behalf of a company to acquire individuals to have a better understanding of whatever that value proposition may be. So that being said, you like the Reg A's, Jillian. So from your perspective, like I know from a bandwidth perspective, sometimes the CF is smaller and it's a bit of a sprint, but we've seen companies go from a CF, even in the real estate, and jump into a Reg A and have a sidecar Reg D on the side.
Yeah.
I don't know, good, bad, or indifferent. I'm just saying that does live and breathe where you've got multiple regulations at the same time. To, I guess, touch a little bit on what Andrew just said. Somebody says, I've got an audience over here for this, but I may have a larger audience on my Reg A based on structuring the deal a little bit different, because maybe this family office just feels that I'm going to put a bigger investment in this. And I guess it's not in the case of a REIT, for example. You have a little bit less control on that. What's your thoughts on that? Like, are you?
Yeah. I mean, we do work on Reg CF in real estate. We do see a lot of sidecar strategies where, people are running a CF and a D simultaneously. They're both totally different profiles, right? So really understanding that, and that the accredited investor is like, you're going for the whale, and the CF, you're, trying to attract a different audience with smaller investment dollars spread around. So, I think, again, that really helps for you to understand the differences between the various regs or the structures out there, because that does have a huge impact on how you're going to go about your marketing plan. Reg CF and Reg D are easy to get structured, get the administrative stuff done. Reg A takes a little bit longer. So we have seen a trend actually in more Reg CFs, and that sort of dual raise between the Reg CF and the Reg D.
So no, and I'm seeing that as well. It doesn't mean they're effective, by the way. And I say this to the audience: hey, this is hard work. It takes a team. Just because you can, we get a lot of companies that come and they say, hey, I want to flip houses. I want to buy a bunch of properties. And my first common sense conversation is, hey, we're the tech provider. We can facilitate anything. But ultimately, we want the issuer to be successful. I want as low as possible costs. I want the issuer to be effective, but going with eyes wide open. So if I'm somebody that just says, hey, Peter's going to go start buying houses and flip them, and I'm going to do a Reg CF and put up a web page, I strongly recommend that, boy, you better be ready for a very tough sled, because you have to ask yourself a simple question: what right have I earned for that investor to participate in my raise? And if you can articulate that message, it's not to dissuade that CF, because I've seen companies start with a CF and become literally $1 billion unicorn, not in the real estate space specifically, but to say that they can't do something, I would never take that away. But recognize that the investor community, they better like what you have, and it's getting more and more competitive. So if I've got CFs are easier, you're going to see more CFs come out there, and you're going to see successful CFs and lots of what I will say soft raise CFs, because they're not going in, eyes wide open. The Reg A side, my comments or thought process to Andrew's comment would be a little bit of, hey, sophisticated offering. If I'm going to spend, $250,000 to get this off the ground, and I'm going to dovetail into potential costs, because the marketing is your biggest cost, I'm likely more committed to measure twice rather than, dipping my toe into a category. Would that be fair, Andrew?
Yeah, I mean, one of the reasons we don't want to do CEFs is that there's just a bunch of upfront costs that have to happen to get a CEF, to get any campaign off the ground. So when you look at fixed costs and variable costs, biggest variable cost is buying media, paid media. And, with that, we don't want to be a high cost of capital. So I've been involved in so many IPOs, mostly in the mid to large cap range earlier in my career. And when you look at cost of capital, it's got to be counted on one hand, maybe a couple of extra fingers. But, if you're 15, 20% of the raise, that's not a very good place to be. Then crowdfunding was probably not the right route for that client. So, there can be no guarantees in work done by an advertising agency or a marketing firm, but there is historic precedent, and there is the opposite of what we learned as money managers. When you're managing money, you're looking over longer time horizons. What we've seen since the pandemic started in 2020 is every 3 months, the entire country is different. And we're going to have different data sets. We're going to have different types of returns, depending upon what our tactics are and what we're going for. And it's going to adjust your strategy. So, dynamic strategy is something that I think we're really good at. And it's funny, sometimes I have to get the young people the 20 somethings in my organizations. Yeah, that worked last time. It's not going to work this time. You got to be more flexible than that. Thank goodness there's an old person here to show you how to be flexible. So,
well, to respectful on those young people, though, they bring a lot of tremendous insights. I'm proud to say.
Well, I can say I'm the oldest member of my team, and I'm very
I'm teasing you in that regard. I've got younger. Well, my kids are obviously all younger than me. This is how that works. So, but the commentary and what surprises me is they're also immersed in these different channels. They're in from a marketing, and so it might be more relevant outside of real estate to a degree. But I think that they're becoming more educated. And you touched on change. You touched on, and I want to get into the change in the marketing channels and what your experiences have been. But the change I guess I'm referring to is, so COVID comes out. A lot of people were sitting at home, and in the public marketplace, all of a sudden, everybody was on Reddit, and I'm talking the younger, the millennials, right, wrong, or indifferent. I mean, there's nothing wrong. They're becoming more educated, and they want to be participants in the capital markets. It started with, with the Robin Hoods on their cell phones. And I personally start to envision, because when my daughter hears all these conversations and presentations, around the house when she's not at school, and she goes, "Oh wow, Dad, I'd invest in that." And she's 21 years old, and I said, "Why?" She goes, "Because I like what they're doing." And she didn't have a financial acumen. She's in the med tech space, but she was having emotional connection and asking the questions. So I bring that up because that's going to be a new generational audience that I think, look, we know that the average investor was surprisingly higher age than I would have thought, because of, and again, I use the Robin Hood quotation side of it. I expected everybody, but I do see a growth aspect coming from a younger generation that says, hey, what are the financial vehicles I can invest in? And not even asking the question, what's a REIT, for example? They're going to say, wait, I can make this money doing that, So that being said, what kind of big changes have occurred? And I want to start with social media. I know in the e-commerce world, what worked 3 years ago is not working today. What are you guys both experiencing? Anyone want to jump in on that?
Yeah, I mean, I think it's more than just social media. It's like you got to think we've moved past just ads on web pages, retargeting, and social media. Like it's every channel, it's every lever you can pull, and that's to Andrew's point, there is an investment that needs to be made, because to be successful in the world's changing markets, which do change on the quarter, you need to be trying everything. with the right data and analytics backing up those choices, and people who've done, have the experience and know, where you're going to garner that success. But, it's not just about media buying. It's about having an email nurture campaign. It's about having the right kind of content, having a narrative that's going to connect with those audiences. And you're speaking about your daughter, Peter, like, they want to connect with the brand. They don't care about, we've seen tons of reports of, the way we used to value companies and was looking at, backward looking financial data. Today, people are evaluating company based on connection with the brand. And that is not, I don't see that changing anytime soon. So it is about the storytelling. It is about the narrative and really being tight on that. And then pulling it all together with all the different options, which there are many. And that's why you need to work with a marketing agency, because honestly, every quarter there's a new lever to pull, and, or a new area to test. And the other sort of part of that is what I would say is that, you do have to plan to stick out and stick with your campaign, expecting to have, the, angel or the, the unicorn investor in the first month. It's never not happened, but, being able to commit to a time period to be in the market and use that time to optimize and figure out where you're getting your best leads from is hugely important. And something to really think about. And again, it goes back to the idea of being willing to invest. And when you're jumping off the cliff, you're, jumping off and believing in yourself, and you have to put some dollars behind that to make it all this, any raise a success.
Well, you touch on brand, and I think from an emotional connection, I mean, everybody looks at two things. You look at certainly the business side and the financial returns. The brand side, I think in this case for real estate, it's the operators behind this.
Oh yeah.
And what's their narrative associated with it. Andrew, we've worked together on projects, and we touched on something like a REIT, for example. And I think in the past you've shared with me, and to Jillian's point of, they better be ready for this journey. It's not going to win the lottery in the first 30 days. And that's the scariest part, I think, from any issuer, is to say, okay, when do I start seeing some traction, and how do I measure that traction? Maybe you can give me some insights in that. I'm going, hey, wait a sec, I'm going to do a Reg A. I know it's going to cost me $250,000. I'm doing a REIT, for example. And I go, I got to be taking a deep breath when I'm 60 days in. I don't have any investors. Or am I going after investors 60 days in, or am I earning the right to get an investor? Maybe you can give me your thoughts on that.
I can, and I just made a note so I don't forget, but I want to go back to your daughter for a minute, who I've never met. So I have no bone to pick with your daughter. I'm sure she's lovely. But if she's anything like I have a 22-year-old daughter who is invested in Reg A plus real estate. She's invested in 2 deals, and I'm 100% sure of that because I made the investments for her. And paid for them, and make sure that she is there receiving passive income and eventually growth. So, the sad truth is that in real estate is that we don't solicit 21-year-olds or even 23-year-olds who are out of college. When you look at income, and then you look at what people are looking for in their investment portfolio, we've got things like meme stocks that you guys talked about. We've got Robinhood. So people who are looking for monthly or quarterly income and then longer term growth and inflation fighting are generally older. So, we're looking a lot at demographics and behavior. And then last goes back to what Jillian was talking about storytelling. So it's not just behavior, but motivation. What's going to motivate them? We refer to as getting to that aha moment, and where they say, gee, I need to get into this. This is something I want to be a part of. But a lot of it is kind of like building any other kind of relationship, which is, how far in do they want to get? Do they want more information? Are they willing to watch a 3-minute video? Are they willing to start receiving some emails, or are they ready to click that CoreConnex Invest button? But even then, as you know, 90% of everyone who clicks that button doesn't complete, if not higher. So what gets them from clicking the button to sign and finish and then ACHing their money in? So timeline is really important, because I want to make sure to come back to that. We take about 60 to 90 days to prep the launch. It's everything from building a web presence for the offering to the literally 125 elements we need to build to do the launch. So all that takes a lot of planning and execution and working with the client, getting through compliance, the whole 9 yards. From there, we like to see investors. How about the first day? Because a little luck would never hurt. But in reality, I think your time frame after the 30th day, when money starts to come in, is a little more realistic. After 60 days, we've done enough testing to start to really scale.
Yeah.
And there is that moment for the issuer where they're holding on, where they're spending more money than money's coming in, let alone being a small percentage, where they need to have the faith that this is going to work. And frankly, it doesn't always. Sometimes it takes 120 days before it really works, as opposed to 60. And with that, you need an issuer who's got the wherewithal to stick with it. We've seen some really good offerings go from 0 to 50,000 to 100,000 to 500,000. And that sucks. Like, keep in mind the size races we're working on. Once we get to 5-6 million a month, no one is looking back, and no one's, all of a sudden we're geniuses, as opposed to we're making them nervous. And that's another thing about the whole Reg CF thing. Once, as an agency, you've seen 6-7 million come in a single month for a single issuer, you don't want to do a raise that is capped at 5 million. You want to continue swinging harder and getting smarter about your audiences, smarter about your messaging, smarter about what channels you're using to get to them. So, the whole idea of making TikTok videos, we do them, but we do them more so that someone checks they're there. We don't see a huge number of people going to the YouTube channel and coming back and dropping $100,000. But we do, do see people going and looking and checking. So it's an important credibility piece.
So it sounds foundational a little bit. Your comment on I'm not out on the millennial, because I have 3 kids, and I would say yes, one of them would have been the meme investor. The other one's in between, and the other one's the far right investor. I mean, he'll save every nickel that he's got. So he would love to see what exists in the case of a REIT. He goes, wow, I like the low risk factor with the nice, stable, long-term income. So I think there is a lot of that, not to pigeonhole demographics.
I need to jump in, though. The risk has nothing to do with the monthly income. The risk has to do with the quality of the issuer and the type of real estate they're investing in. So, is it already income producing the day they put it in? One of the big questions an investor should ask is, what is the lag time from the day I invest to the day I get my first dividend check? And is it truly a dividend, or is it a return of capital? Because return of capital is just BS. So, sorry.
No, fair statements. So I'm hearing it's okay. We're going into this 90-day cycle. My analogy often is, stay away from pray and spray. I get people that say, okay, I've got an email list of 50,000. Send that email list out and everybody to come to invest. I personally just look at it as, I'll come back to a past life in the e-commerce space of I had to earn the right. I had to earn the trust. I saw that pair of shoes 10 times before I bought that pair of shoes, and I got halfway through the checkout cart. So at each stage along the way, the issuers, they're simply touch points, are they not? And trying to make some sort of connection with me that elevates to a level of trust. What's your take on, I hear that, the traditional, okay, so you need X amount of touch points, whether it's 7, whether it's 8, whether it's 10. Um, you talk about, we talk about email, we talk about sales funnel, we talk about social media channels. Um, Between the different regulations, are you using all of them all the time, some of them all of the time? What's that journey look like? Um,
We always try to start, we're using most of them all the time, again, because we have probably the same approach as Andrew. Like, we want to do serious testing and find out where we're getting the most success, and then optimize the media investment dollars to that place, right? So that's sort of the first. I would also say it's the placement is one thing, and it's an art and a science all on its own. I will go back to the quality of your narrative and the quality of your content. You're right, people want to see your roadmap. They want to understand what this money is for, right? Those are really basic things, but that we maybe overlook or say, yeah, it's just in this deal, but what is it for? Especially when you're doubling up on doing the sidecar reg CF, reg D. Like, you've got to explain what you're doing it for and what that roadmap looks like. So you need to be providing, a high level business plan to help, because this is a sophisticated investment. It's a sophisticated asset class, and people, and it takes time, right? These things don't go up overnight. So I think, really providing that level of information and detail is important in order to get those conversions. And Peter, too, with our analytics show that it takes between, in real estate, about 7 touch points to do that kind of conversion, which means through email, it means through ads, it means through an email list, your website, and all those things, but about 7 touch points.
Somebody just made a comment. I think it's now 21 touch points. So it just says it's getting harder and harder and trickier if you're not navigating. I'm hoping it's not 21, or the issuer's expense of marketing may be going up exponentially, but maybe it can be done cost effectively. I got a question here that somebody was asking, and it's to do with this space. And want to know if either one of you have experience with this. I mean, I've got my commentary on it, but can one raise funds before identifying a specific property? Well, the answer to that question from a legal perspective is yes, but more from a marketing perspective, my takeaway would be more of, sure, but why do I want to invest in you, and how do I market that proposition? Do I have a track record? I see that in REITs with, a lot of projects where it might be a fund that's going to say, I'm going to do rental storage units, for example, and the company's done this project a number of times, and they say, hey, we're raising a fund to do storage units. They don't have the storage units yet, it's in the property there, but they've articulated something that they have a track record or credible in a past life to go into this new sector that, hey, is it may be worthy to the investor. Comments on that for this for one of our.
Sure. So land deals are near impossible, and maybe
Agreed.
There we go. So 2 reasons. One is that there's too much risk involved, and there's too long of a time horizon involved before there's going to be any kind of payout. And then last is the unknown of all the things that can go wrong, from regulations, not in the offering, but regulations in building. So we had a land deal. It was an 18% deal. We got tens of thousands of bites. And when we told the client the deal can't be done, which was a huge, humbling experience for everyone, it couldn't be done the way it was being done. It had to be repackaged as a Reg D. It needed to go institutional. It needed to get bigger. But individual investors, they see 18%, they're all over it until they realize 18%, that's not even real. We had another deal almost at 18, and I made them drop it to 12, deliver 14, and pocket the other 4, because no one thinks that 18 is credible. So, you're looking at an ad somewhere. What is in the realm of possibility? What's the standard deviation away from it? So storytelling is so important to this, to underscore what Jillian was saying, which I agree with completely. But it's going back to your journey thing. It's the right message to the right person at the right time in the right context. And you need all those things to align. And then I don't believe, I forgot what that 20-something number is. It's way less. We've seen people, I don't know how many ads they saw, but I know it's the first time they clicked and they've dropped 100 grand. I've seen it where they've gone in, they've been nurtured, and then they put in $5,000 and they did it 6 months later. So the patterns change, and the pattern is different for each issuer. There's a lot to be learned from every single campaign we've done. There's huge amounts to be learned, but expecting something to happen exactly the way something else did, I think it's called past performance is not an indicator of future performance. And I would say that's true in marketing, not just in investing. Anyway, we don't care how many times someone has to see an ad. It's not that important.
We'd all like for me to do an email blast, and I've got a database, and I click on a button and I make my investment. But being a realist and a pragmatist, it doesn't happen. So
I'm going to interrupt one last time, and then I will shut up so I don't overstate my time here. There's no such thing as doing that. You would have to have an
100%.
issuer who had a database where they had a double opt-in relationship with everyone, where they could do it. If you're doing a list rental, good luck. There's so many other ways of getting to people, and we're huge proponents and use email every day. Just not like that. And then last is 50,000 is such a tiny number. I don't even think we would waste our time doing it with a list that small, unless it was the client list, in which case then it's very valuable.
Or you're starting the journey. You're saying, I want to filter. I'm not asking you for anything. Maybe I'm providing education, but recognizing that however I use these tools, I've got to earn the right. I've got to, whether it's a sales funnel, landing pages, splash pages. We live and breathe in the educational marketplace at Core Connects, and doing panel sessions like this and discovery sessions like this. We don't do these because we're expecting to get, oh, wow, somebody saw this once and they're going to buy. It's a journey. And I think that's the same, capital raise it's building those relationships and building those trust levels. Let me ask you both a question. So we touched on different audience sectors and difference between a Reg D and a Reg A, for example. The Reg A, I certainly have a wider net or the potential, but I also have the potential to spend more money. I get a lot of clients that come and say, oh, I'm going to do a Reg D because my offering is ABC. And my first question is, do you know anybody? Do you have any? And like there's this belief that, oh, my value proposition, put it up there, is so compelling that the accredited investor just comes. Is the marketing on the Reg D side of it different than your Reg A side of it, or there's a lot of overlap? I don't know who wants to jump in on that side.
Yeah, I agree with you. It's a myth that there's some website that all accredited investors go to. The Reg D, it's typically a sizable investment. These people need to be educated, nurtured. They need to be laid out the plan. They're usually pretty sophisticated if you're investing that kind of money. So they're really looking at your business. And so that's going to be an important aspect of it. But the Reg D people are not in one place. They're everywhere. You have to orchestrate the same mechanics and thought and strategy for Reg D as for any other raise. and puts, I think what also for me, the big nuance there is the messaging for that audience. And, think about maybe even having a different landing page, different content, maybe more, sophisticated content, some more, like, we know video is huge, and especially in real estate, to have, the people developing the property speaking to it, builds a lot of trust and credibility. So that's a great tool. But I think you do need to think about that when you're trying to attract that Reg D investor.
So, again, it's identifying your audience and what your reach is, and where those members. Do I leverage existing databases that I may have that have value versus just a list? Or if I have a list, I nurture that list without a pray and spray mentality.
Yeah.
So let me ask a question on, if I'm doing a Reg D and I'm going after the accredited, my Reg A Plus allows me to go after the accredited and the non-accredited. From your experiences, are you finding, I just know on the top of mind, Andrew, there's an offering that you have currently that it's a Reg A. Do you know what percentages is accredited versus non-accredited in that raise? And it's a little more expensive raise in the real estate as far as minimum investment goes.
So it's a timeline. We launched at $500 and we had non-accredited investors mixed with accredited. I would say the typical investor now is qualified, not even accredited, above accredited. And now it's a $5,000 minimum. It's probably going to go to a $10,000 minimum. So why do Reg A at all at that point? Two things. One is they want to be open to everyone. They actually had done an institutional raise where Goldman Sachs was the selling agent. And now they just want all their investors directly. And that is why we created these different data sets of, we've got over 1 million people who have a PhD in our database. So that type of, educated audience is looking for something specific or has the ability to grasp it. And I can tell you right now, they love anything. Oh, this one has solar panels on it. Oh, that audience is going to like it more. Where this audience hate that. So, we advertise on MSNBC and on Fox News, and you need to know who's watching both, and it's totally okay. We do, I'm going to contradict myself and say we're about to do a raise, which is a Reg D, and it's affordable housing. It's in an opportunity zone. So it's got huge tax benefits. The Reg D crowd's going to love that. We will not be going after accredited investors, though. We'll be going after professional investors. So endowments and foundations, family offices, public funds, Taft-Hartley, et cetera. And then a CF. Yeah, because we want the community to be able to invest as well. And this issuer is tough. They're like, no, CF's getting the same damn terms as the Reg D is. They're just because they're writing bigger checks, they're not going to get something else. But it's only 5 million of a north of 100 million raise. And that's another reason not to do an A+.
I think we're closing out on something just what I love to hear, which is brilliant. That the concept of the Jobs Act was to democratize capital. CFs, Reg Ds, Reg As, the ability to solicit the public at large didn't exist for the most part. For general solicitation, and hence your businesses are growing from the perspective of, hey, we can have general solicitation, but to do it smartly. And I appreciate that final comment, Andrew, because you kind of had me going, Andrew's only really selective on that, but you do see that other side for the right project. Yeah. And I do get a lot of communities saying, hey, we're going to do something specifically to be better a community and have small investors, large investors participate. A little bit of ESG going on in that space, but it doesn't mean it's not intelligent and sophisticated, but there's an emotional connection, which is really what marketing is all about. Let's be honest. We donate to certain charities that have an emotional connection. Doesn't mean I can't have an upside, the fact that I invested in my community, but that may be a particular reason for me to invest in my community. So I think all the regulations can afford that opportunity, and that's exciting. And again, it's I don't know who said it. I talked to earlier in my past session whether they thought we're on first base, and maybe I think you said it, Andrew. I think we're just building the stadium right now when it comes to this marketing. But
that would have been months ago.
So it's. I think the regs are transformational. I think the insight that you two both provided today is not only inspirational and educational, but hopefully noteworthy to our audience. It gets me excited when I end the day on these kinds of conversations, because it's changing the narrative, changing the landscape, and it sounds like measure twice, know your audience, and make a connection. Be prepared. It is a journey, and hire the right firms to assist you, because you need a team. So, any closing comments before we close off the session?
Go ahead, Andrew.
So I just wanted to give Reg A Plus another plug, which is people have come to us and wanted to do a Reg D, and they're raising $55 million. I'm like, oh, spend a little bit more money and do a Reg A, and then you're going to save it on the back end because you don't have to do an accreditation check. So all of a sudden, the paperwork for the investor becomes an awful lot easier, and for you as an issuer, a lot easier. So, or they say they're raising 200 million. Well, you can't be doing a Reg A. Doesn't matter who you want to raise from. Now you have to do a combo. And so mixing and matching and structuring these, I'm not a 79, meaning I'm not an investment banker, nor am I a lawyer, but I've seen an awful lot of deals. So we love to get in early with the issuer and make sure that they're in the right structure, aiming for what they're doing. So, and thank you for inviting me to this. And it was really nice meeting you, Jillian.
Thank
Great
you,
to
Andrew.
meet you.
Any closing remarks, Jillian? I'll end on you.
Yeah, I mean, I'll go less practical, more, but I think choice is something that we need to be embracing with looking at various regs and various structures, but also even incentives. Like, if I'm, that's a huge part. I totally love what you're saying about the democratization. This is where we're going, and where, I think a huge trend in the market as a whole. And so giving people choice to what vehicle they want to, invest in, I think is a really interesting thing to think about and consider when you're trying to figure out what structure to go with, and maybe even tie in some incentives, which, for a certain investment dollar value, you're going to get X. Like, we're working with a firm where it happens to be, a gift card to go to that particular place, once it's developed. So those are other trends that we're seeing that can be quite interesting and engaging for people, and they look twice. So.
And to close out on that, that's the direction for the next session. We didn't even get to touch on that from a marketing. What are the different marketing avenues that one can do? And to close out, the ability to incentivize investors in wide and far-reaching approaches is extremely interesting when it comes to these regulations. And again, that's a whole long conversation in itself that a lot of, I think, the audience might not be aware that. I didn't know that you can incentivize investors in a very number of sense of urgency, dollar values, gifts, whatever it could be, whatever it connects with that audience is a very, very compelling thing that can be done from a marketing perspective for all these regs. So on that note, I bid you farewell. Jillian, Andrew, thank you very, very much for the afternoon, and I appreciate your insight as always. Thank you.
Super. Thank you, Peter. Great to meet you, Andrew. Bye.
Nice meeting you.